Well, let's start the conversation this morning with Robert Luna. He's the CEO of SureVest Wealth Management, joining us live out of LA this morning. And Robert, your reflections on the dismal start that we've seen to the second quarter. It seems like investors are still really concerned about the trajectory of the virus, and that's just something that markets can't really price at this point.
Yeah, no, you're exactly right. I mean, there's just a tremendous amount of uncertainty. And I think as a risk manager, when you're unable to get your arms around things, I think you shoot first and ask questions later. I think that's what you're seeing going on Wall Street right now. There was a lot of talk about rebalancing because obviously if you started out at the top of this market and you're in a 60-40 portfolio, that's probably gone the other way to where you're 60% bonds now and 40% stocks. I think a lot of people were putting their hopes on that rebalance. But I think, again, to your point, with all this uncertainty, I think cash is a viable asset class. So I know in our portfolios, and I think you're seeing that across the board, people are keeping those cash levels a little bit higher than normal just because of the tremendous amount of uncertainty surrounding this virus.
How reactive are these markets going to be to the upcoming data? There's a new worry about what we're going to see with regards to the jobless claims figure and then the NFP on Friday. What are we expecting?
Yeah, I mean, the numbers are all over the board. You're hearing anywhere from 3 million to 10 million. So again, there's just such a wide variety of what we're looking at, and that underpins the amount of uncertainty that we're dealing with. That being said, I think where the market's at right now, let's remember in the U.S., we rebounded about 20% off the lows in a very short period of time. We're getting some of that back. Retesting that is more than likely, in our view, going to be happening. I think what the market's pricing in anywhere between these levels and back to that retest, though, is this economy on some level getting back up and running again sometime in May. Now, obviously, there's going to be social distancing, those types of precautions that are going to be put in place. But if you're going to see this economy shut down, if you see President Trump come out and extend that another month, I think there's a little ways to go further than that. Instead of 2,200, you probably test 2,000 on the S&P.
2,000 on the S&P, which would be essentially breaking below its previous low of 2,200. Let's talk about your strategies, Robert. You're essentially saying that you want to pair dividend stocks with technology companies. As you heard, there's been a growing debate about how, with pressure coming in on cash flows, the one area where companies may want to cut back on would be dividends or paying out dividends. How much of a lure does it remain for investors such as yourself?
Well, I think dividends are very, very important, especially when you're looking at the Treasury, the 10-year yield now just about 0.6%. So for income-oriented investors, and I think what the CEO of Morgan Stanley was talking about, a lot of people are counting on those dividends. Now, I would caution investors, though, that all dividends are not equal, right? So if you're a bank, that's a whole different situation. You're seeing that globally, where banks are asked to cut those dividends back to be able to sustain liquidity needs. But if you look at some of those staples, companies like Procter & Gamble, Colgate, even a big, cash balance sheet company like a Microsoft, these are companies that are not really being impacted. Unfortunately, even for some of these staples, they're having a huge surge in their businesses right now. So those are the types of dividends that we're referring to. If it's some of these financials and some of the ones that are the outskirts with a lot of debt on their balance sheet, those are the ones that we'd be a lot more cautious on right now.